Hi. Has this question ever crossed your mind as to how a VC decides on the stake that they should ideally be looking for the investment that they are coming up with? So I'll explain it to you in the next sheet. So it's basically a six-step process. So let us look into it. So as we see, the first step is determination of the exit date. So the very day they make the investment, they have a clear horizon for which they are making the investment. Post that, they decide, say in this example, of going public, right? So determination of exit date is very important as the first step. The second step is forecasting of free cash flow. So suppose they intend to make an initial investment of $5 million, for which they are looking for a cash flow, free cash flow of $1 million in year one, $3 million in year two, $7 million in year three, $10 million in year four, and $20 million in year five. Uh, in step 3, they try to determine the exit value. So, say after 5 years, VC forecasts that the net income would be roughly around $5 million, and let the publicly traded companies in the same line of business be trading at PE ratio of 20 times. So, the exit value gets to be 5 into 20, $100 million. So then the free cash flow figures remains the same as what we have mentioned earlier, and the exit value gets to be 100. So in step 4, we see, say, has a target return of investment in mind, say that's 65% in this case. Post which they, in step 5, they undertake the valuation. So the free cash flow and exit value is as similar we have discussed earlier. So the total cash flow is just by adding these two, and so for every year it remains the same, other than for year 5, where it gets to be 100 plus 20, which is equal to 120. So the discounting rate at 65% gets to be 0.65 in year 1, 0.42 in year 2, 0.27 in year 3, 0.18 in year 4, and 0.12 in year 5, right? So the present value as on year 0 gets to be 14.55, and present value including initial investment gets to be 19.55, right? So that is the sum of D40 and H40, right? So that's how we get this figure. And so as step 6, then we determine the equity stake. So the pre-money valuation, as we have seen earlier, gets to be 14.55, and the post-money valuation, which includes the initial investment to be decided, that has been decided to be injected, that gets to be 19.55. So the stake that gets required gets to be 5 by 19.55, that is 26%. So this gives you a rough understanding as to how the VC decides on the percentage stake that they are looking for. I hope it added some value to you. So if you liked it, just give a like, give a share, and subscribe to the YouTube channel. And if you want to get such videos, like whenever we update, you get to know about that, please press the bell icon, right? So see you in the next video. Thanks a lot.